most traditional, and there's some great financial advisors, but most traditional ones, you said it, are just mostly salespeople. And they have no incentive to look for superior investment opportunities. They're just going to sell what products are available. And, sometimes it's maybe to avoid risk. You don't get fired for recommending Apple, that type of thing, or the S&P. But, when it's down 20% and, real estate syndications are still spitting off 5-10%, they just don't have any incentive to promote those types of deals.
That was Jack Krupey. He's a principal of JKAM Investments. And this was a really great show. We got into a lot of mindset and talking about what it means to be an investor and why you want to do that. Stay tuned. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing the real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, partners, we're back again for another episode of the Limited Partner Podcast. This week, I'm joined by Jack Krupey, who is the principal of JKAM Investments. Jack, welcome to the show.
Thanks for having me.
Well, this is, it's exciting times, and I can't wait to get into it. And, you've got some interesting, thoughts on the last straw moments, and I can't wait to get into that. But first, for my guest out there, or for my listeners out there that have not met you or heard one of your other podcasts, I would love to give you an opportunity. Give us a little bit of background on you and JKAM.
Sure. So I've been in real estate over 20 years at this point. I actually got into my first rental when I was 22 years old. I had been through a couple crashes already because I graduated during the dot-com crisis. So I went from thinking I was going to be this high-end computer consultant to within 3 years had quit my job and was building up a rental portfolio, got my real estate license, was buying, selling, brokering, wholesaling, really all the traditional beginner real estate strategies, and ended up essentially creating myself a job. Property management and owning small 1 and 2 family units is really not passive. Then fast forward to 2008 during the crisis, found there was a private equity fund in New York City that needed real estate people. They were buying non-performing mortgages from banks. And, our market had basically froze up because of the financial crisis. It was very difficult to buy, and made a pivot to work on the hedge fund side, and ended up working at a firm for about 2 years, then went off and launched my own. And then we partnered with a private equity fund in New York City and actually helped them deploy $3 billion into buying non-performing mortgages. We transacted with Goldman Sachs, Fannie Mae, Freddie Mac. It was an amazing run, an amazing business. But again, also at that size and scale, I essentially created myself a job again. And it was that New York City grind. So I've always, and one of my early mentors told me, you want freedom more than you want money. And obviously you need enough money to generate the freedom. But I've been chasing that passive investment lifestyle for over 20 years. And, over the course of it, I've often created myself jobs. So I was fortunate to be able to move to Puerto Rico, and I actually got bought out of my prior company, and it was pretty efficient from a tax perspective. And for my next chapter, I was really trying to find a business that supported my lifestyle, but also didn't become, that grind, that job that I've done in the past. And I also had a bunch of my own money to invest. So I'd been investing in syndication passively for a number of years, and I was going to do that anyway. So ultimately we launched JKAM to really build a fund and a business around my actual personal investing that I was already doing. So somewhat monetizing my mission, if you will. And now I really enjoy it. We work with about 15 different operating partners, and we have 2 different Reg D private placement funds. And I spend my days combination of educating and talking to investors, as well as networking with, really good operating partners that even the best operating partners need help networking to raise capital.
Well, I think, a couple of things from your story that I think are kind of fascinating. You are the second person that I've had on the podcast that has moved to Puerto Rico for the tax efficiency. So there's something real there.
Yeah, it's life-changing. And obviously the taxes is a big benefit, but the network down here is incredible. I was at an event last night with about 100 entrepreneurs that moved to the island. So it takes, generally you need to have made enough money that it makes sense to try to make the move, but also have that sense of adventure to do it. So it's like joining a country club. Instead of paying a membership fee, you save 90% on your taxes.
Yeah, I don't know. I think it's fascinating. I'm going to have to keep digging into it because I do have a sense of adventure and I think Puerto Rico sounds pretty cool. It's just a matter of, can I convince my wife and 4 kids that's the right move for us? Well, TBD on that one. I think a couple of things you bring up a lot is kind of your last straw moment. And I'd love to hear a little bit more about what does that mean exactly?
Yeah, for me, it was just being in New York City, making more money than I'd ever made in my life in this wildly successful business, but being miserable because I did not have control of my time. I had great partners, but they came from that Wall Street grind type of role. And one of them, it was somewhat of a badge of honor that he didn't see his kid for multiple days during the week because he'd get on the train before his kids woke up and he wouldn't get home till after. And I always wanted, that more passive income lifestyle. And for me, it was, even though I'd been an entrepreneur for most of my life, I really kind of backed myself into, somewhat of the golden handcuffs, if you will. And for me, it was just figuring out that there was, things more reminding myself, I should say, because I knew it when I was younger. And then sometimes you lose track and you get into, you just get into the grind. And for me, it was really just figuring out how to reclaim my lifestyle and, have a business that works for me rather than me working for my business. So it took a year or two and some stress and ultimately it worked out, but it was very, took a lot of thought and a lot of structure over a few years to just figure out the path forward and just get back to the point where I can, reclaim my lifestyle and my time and just have a business that I enjoy every aspect of.
Yeah, that's a really interesting story because I have a parallel is that, I had a business, I sold it, I worked kind of earned out for a few years and then was recruited to join as the CFO of a company in New York City. And very similar to your story is that like you get into New York and there really is this just, hey, we're going to work all hours of the day. And that is like that's how you really got it. You're doing the right thing. It was funny because I was in the office and I was commuting. I live in Charleston at the time and I was commuting with a plan to eventually move once we kind of figured out, once the dust settled and where we wanted to be. And, I was in the office with people. I was like, what are y'all doing? Half the time I felt like people were just hanging out, right? And like setting themselves up to stay till like 9 or 10 o'clock as opposed to actually just being super efficient with their time. And I came to this realization that like I actually would see my family more commuting Monday through Thursday and like literally being gone, not seeing them, but I would be there all day Friday and all day on the weekends. And I was like, to your exact scenario is that, we'd be, we've got 4 kids. I'd live in somewhere in Connecticut or New Jersey, probably. It'd be an hour ride on the train on the front end, an hour on the back. I'd never see my family. So similar to you, I kind of hit a last straw moment where I was like, this is miserable. Like I can't keep doing this. So I've been there. I think that's a very interesting segue there.
Yeah. Well, kudos to you for escaping as well. And the other thing I'll just mention real quick is when you factor in taxes, for those that may be on the cusp of deciding to, maybe make a change, one of my wake up calls was I owned a piece of the business. So the last year I was there, my K1 far exceeded my salary. So it's like I was also grinding and only keeping half of that grind as well. So, if you look at my hourly after taxes, it really was not that significant. And when I left, the income became passive instead of active. So by leaving and then investing in syndications with bonus depreciation that were in many cases generating 100 cents on the dollar K1 loss, I actually in some ways made money by leaving as an employee. And some people may be in that situation, especially if one of the two spouses can become a real estate professional. There's a lot of interesting tax loopholes where having that freedom and flexibility and becoming limited partners in deals can actually save you money.
Yeah. And then interesting you bring that up because several weeks ago we interviewed Christine Shu and she said the exact same thing. She left her job and was actually better off focusing on investing in real estate than having 2 incomes. And the power of depreciation, what you can do, especially if you're bringing in significant money in the depreciation and your investments are holding, like there is a lot of power there and there's a way to keep pushing it down the road. Now, I always caveat this by saying is that there's a lot of people in the real estate industry, especially that are, touting information that make it seem like depreciation is this just like completely magic bullet. Eventually, like when you sell and dispose of assets, like you recapture depreciation, right? So it's not like it just goes away, but you get to use it now. But there are ways to defer it and keep pushing it down the road. And you probably can push it down the road indefinitely. So there are some strategies, but I just want to make sure everybody, appreciates that it's not like it just, you get depreciation. It's like, wow, I've got this free expense that just negates all of my income.
Yeah, that's a very important point. And, there could be some gotchas. We did have a deal that closed, and luckily it was a small amount of money, but it sold on December 25th, or not December 25th, but it was the last week of December it closed, and there was no time to redeploy. If something closes in June, you've got another 6 months to calculate what your potential capital gain is, and you have time to redeploy. So, but it's a great, powerful tool for those that are maybe approaching retirement, and in a few years their income may be lower, or if you're going to move from a high tax state to a state that has no state income tax. There's certainly plenty of benefits. And I think just the more you can defer taxes, just take advantage of time value of money, generally the better. But, it also becomes a job as well. I mean, I have a spreadsheet of all our deals of basis, and, tax planning becomes a chore and something you need to, once you're on that hamster wheel, you need to, track all your investments to make sure you don't have a surprise.
Yeah. And that definitely becomes a job. And I think that is the other thing. I mean, it's funny, the show, I feel like, we really started on real estate, but it's becoming a mindset, discussion, which I love. Actually, really appreciate this, is that there are so many ways that you can just create another job for yourself everywhere you go, right? So like you get a lot of investments out there and all of a sudden you've got to track them, and then there's money coming in, what's happening? And then it's a job just to manage that. Or you think you can do all this work. Next thing you know, you're a property manager, you're taking calls at midnight, right? And having to do all this crazy stuff that you didn't mean to. And I think that really designing your life and setting your goals up front in what you want. And you made a really great point that I want to bring back into this conversation, is that you don't want the money, right? Like you think you do, right? Like that's the initial, but it's a cheat, right? Like you're cheating. What you want is the lifestyle and what you think money can get for you. And you've got to be very careful about what you get yourself into, that you don't just create another job, right? And you keep kicking this lifestyle because you just said, hey, look, I just want a bunch of money. Once I have a bunch of money, I will do this. And maybe I'm on like all on this, harping on this because I picked up the book, The 4-Hour Workweek again. I've read it probably 15 times, but there's a quote in there that really hit home with me. I was listening to it yesterday on a walk, and it was, busyness is a form of being lazy, right? Like when you just get yourself busy doing stuff because you feel like, oh man, I did stuff all day, right? Like, look at me. You're actually being super lazy as opposed to figuring out what it is you want out of life and doing that instead. And it's harder to do the latter.
That's a great quote. And I love that book. I've actually, when I've been asked for book recommendations or top books, that's one of the first ones I'll list. I read that in either 2007, 2008. It was really during the financial crisis when I was trying to figure out kind of what, how to pivot our business, what to do next. And that book was, somewhat, I hate to say life-changing, just, dramatic, but it was there and it was so ahead of its time. Think about everyone now who has virtual assistants. That was really the first books that I think brought that to the mainstream. And, the whole geo arbitrage. I actually went to Argentina last year. They have the same currency crisis. Basically every 10 years, they have a currency crisis. So if you go to Argentina with cash, you get 2 to 1, essentially. You get double the exchange rate if you change locally at like a Western Union or just a Cambio than if you do at the airport. So I had a two-pound ribeye and a bottle of Malbec for $12 at one of the nicest restaurants in Buenos Aires.
You're like a king. Yeah. It's funny because every once in a while, like I just have this like sense I need to pick up a book I've read in the past. And I've been kicking this one off for a while because I'm like, I read it, like I get the concepts of it. But your point about it being ahead of its time is so true, because it is, I'm listening to it now. I'm like, oh my God, this is like so applicable now. Like even more then, because like back then it seemed like a lot of the stuff that he was talking about was a stretch. And now it's like really starting to come into the mainstream. So I don't know if he was clairvoyant or like he started this trend, but there's so many things in that book about like, how do you manage your time? What are you actually trying to do? And, why are you busy? Right? Like, why am I busy? Like, why am I doing all this stuff like reading email, news, and all of these things? Because I'm actually avoiding the harder decisions of like, how do I actually live the life that I want to? And I think I'm doing a pretty good job of designing that life. But at the same time, like, it was amazing to kind of pick up this book that, like I read probably in that 2007-8 time frame when I was going through a transition, especially and jumping into real estate full time back then, and trying to figure out how to make it all work and live the life. And like I got into real estate. I read the Rich Dad Poor Dad book and went out and bought as many rental properties as I could, and then realized, oh my God, I just created another full time job, and then one that doesn't have hours, right? Because people call you when there's a problem, and the problems never happen at a convenient time. So anyway, I appreciate your thoughts on especially this last straw moment, because I've been there, and I think you're designing the life that you want, and then you're doing it through passive investments.
Yeah. I mean, often when I talk to people, their first, and these are high earning professionals, their first thought is to go buy an Airbnb, to buy a single family house. And, I think there's not as much information out there on these types, the types of opportunities through syndications and multifamily storage, mobile home parks, student housing, senior housing. So I think everyone's default is to just go the traditional route and buy a house and be a landlord themselves. And it's, there's partners out there and deals out there that actually are going to do a better job than if you try to do it yourself for the most part. I mean, there's certain, if you're an operational engineer type person and you just really enjoy that, then, so be it and enjoy. But, great majority of us that, I think are on the same mindset we are, that really want to have their time, the syndication opportunities are far superior. And it's just a matter of exposure. Publicly traded REITs where you can click a couple buttons, pay a 5% dividend. Whereas, these private opportunities used to be country club deals, but now with, the Jobs Act and, the law changes just are able to be, the country club just becomes the club. And, it does take some work too. I mean, I've used the term active passive investing. I travel to a number of mastermind seminars, conferences. I'm actually going to Cabo in a week and a half for a mastermind group with probably about 80 investors, combination of people that are operators that want to network with funds like ours, as well as other groups that are on the capital raising side. And that's where the work is. The work is done ahead of time to find the opportunities, that the sponsors, get to know other investors that invest with them. And then, they trust them that their level of expertise can handle the operations and do that. For me, I know they're doing it better than I would if I was going to attempt to be an operations person, and that's not my skill set.
Yeah. And one of the things that I always want to try and hammer home too is that it is work. Like, you cannot just assume that it's like your 401k, where like, you've got a 401k and your company maybe gives you some guy like, hey, call, Bob or Sally over there, our 401k person. And then they're like, tell me about your life and your goals. And they're like, okay, here's the 3 investments I think you should be in, and we'll diversify in a couple years. Like, that ain't how it works. You got to work, right? You got to go out and you got to find the right people, the right markets, the right assets. But what I think is important too is that like, you can make it fun, right? Like, you can make it an enjoyable process. Like, for me, and like probably 95% of the reason I do this podcast is that I love meeting people that are doing these things and they've got an interesting angle. And if you take that mindset and say like, oh, it's not work, it's about finding great people, like, it becomes less work. And then you're talking about going to do this at Cabo. Like, that doesn't sound terrible. Right?
Not at all. Not at all. And most of the time conferences are in fun locations.
Yeah. And that's part of the strategy, right? Like, design the business and the life that you want to live, and then figure out how to make it fun and interesting. And like, honestly, connecting with great people. Like, I would rather have 100 conversations and find a couple great people than be like, man, this is a lot of work, and I just basically park my money with the first person that tells a good story. But the reality is, a lot of times the people that are really good at telling the story and marketing are just marketers, right? They actually don't know what they're doing. Whereas like, when you meet people that get it and are really good at it, like, you just kind of know. But you got to kiss a lot of frogs, right?
Exactly. Yeah. Most traditional, and there's some great financial advisors, but most traditional ones, you said it, are just mostly salespeople, and they have no incentive to look for superior investment opportunities. They're just going to sell what products are available. And, it's sometimes it's maybe to avoid risk. You don't get fired for recommending Apple. that type of thing for the S&P. But, when it's down 20% and, real estate syndications are still spitting off 5-10%, they just don't have any incentive to promote those types of deals. And, the information is not all in one place either. I got some feedback from one of our investors that, we were just, I know a little bit about a lot of things. So I don't have one of those life insurance policies, but, I know a few groups from masterminds that do the infinite banking, and they're selling the policy where they don't make a lot of commission, because if you can basically borrow almost all your money out of it, there's not a big sales commission for it. So there's groups that specialize in that. There's groups that specialize in solo 401k. And there's not one source where you could say, hey, here's these, top 10 vendors for, every piece of being a self-directed investor and a passive investor in the syndication market. So there's a learning curve, and, these masterminds are great for it because you can get a lot of good information from like-minded people in one location.
Well, let's probably get into what I thought we were going to talk about in the show a little bit more is, this current marketplace, right, is a challenge, right? We're seeing valuations go down. Like, I guess, what are your thoughts? How are you investing? What would be your suggestion for limited partners out there that are trying to figure out what to do?
Sure. So, if you're starting now, it's a really good time. That interest rate move was, kind of a once in a generation fast increase in interest rates. So, going in now, I think is probably the least risky time because, unless rates I don't expect rates to go to 10%, 15% like the 1980s. Frankly, the government can't afford it because the GDP is so high. But, if you were on the fence and or concerned, I think, you can be less concerned now because rates are towards the top. Prices have adjusted to some extent. And, with that said, the value add multifamily, the cap rates are still relatively tight because when you have so much upside in raising rents, which is, the main area we focus, is forcing appreciation through, buying a 1980s or so vintage apartment building, renovate half to all of the units, increase net operating income, and eventually sell or refinance. So I think coming in now is probably safer than any time in the last 5 years because the rates have moved. And one of the other positive factors, and we look at this for sort of how our current deals that we got into before the rates moved exit, is the 5-year and the 10-year rates have already dropped significantly. That was actually one of the benefits of the banking crisis. Is I think they dropped 50 basis points the day Silicon Valley Bank failed. And the logical exit, a lot of the loans are bought with bridge loan debt, which is causing, any pain that's out there right now for those invested in the syndication deals is largely on the bridge loan debt. But the exit strategy, the 5 year is at 3.8 right now. You add about 180 basis points. You can refinance into a loan in the low fives right now, which is pretty that rates in the fives on and off the last 20, 30 years have been attainable. And I think that bodes well for the long-term exit on deals. There was a high-profile foreclosure in Houston recently. There's certainly going to be some deals where the operator is not executing properly, where they didn't have an interest rate cap, where they did not raise enough capital to be able to, ride out the higher interest rates. Fortunately, we don't have any capital calls in our portfolio currently, but we do have a number of deals in our initial fund that, especially deals that were bought, say, January of 2021, January 2022, right before the rates went up, that really have just enough cash to cover operating expenses and debt service. And that 3, 5, 6% cash on cash that was supposed to be the first year cash flow is really just not happening. That money is being saved to cover interest expenses and potential extensions or our interest rate caps. So, it's not without its challenges. My analysis of our portfolio at large is that the operators that are good are just renovating units faster and really focusing on growing the net operating income so that when it comes time to sell a refi, the increase in net operating income more than covers the increased debt costs. And cap rates are holding up. So I mentioned the interest rates being in the fives. So if the interest rates for the long-term buyer, which is more of a family office or maybe a smaller institutional buyer, they're going to buy in the five cap rate range as long as they can get debt in the 5 cap rate range. So I'm cautiously optimistic, and I think there'll be certain operators and certain pockets maybe that have larger challenges. But I think as a whole, if you're in a deal where the value add is executing and rents are going up, yeah, I think you should be in relatively good shape.
Yeah, I think you bring up a really interesting point too about renovating faster, in that, with the developers kind of out of the game right now. There's where there used to be kind of a labor shortage. Now I think we're probably seeing an influx of folks that were, they were yesterday they were building units and now they're looking for work. The ability to kind of quickly turn units is probably better in this value add strategy. And the pressure is still there, and I think that the fact that we're not building units just exacerbates that pressure, right? If there's a housing shortage in a market and builders are saying like, hey, we're not doing anything right now, then we're not alleviating that. So like the pressure on rents are still there. So fundamentals for the multifamily space are great, and it's just a matter of the next probably 6 to 12 months to see how some of this stuff shakes out.
Yeah, absolutely. Yeah, I'll get sent articles about certain markets where it says rents are dropping, and we're just not seeing that. I think if you're in that Class B type of space, there's you cannot build those units for replacement costs. So rents may be dropping on the highest end Class A markets, but if you have a quality $1,200, $1,400 a month apartment, that's where the major shortage is. And we're seeing rents, rents are stable to still increasing it in a majority of deals. We're in close to 40 deals and really across the Southeast and Sun Belt. And we're not seeing any issues with rents. And the lowest end of the market, the Class C, sometimes they get hit a little harder with inflation or with recessions. But there's an employment, overall. I mean, I think construction that's certainly a benefit, but overall, just for the average tenant base, I mean, there is still a major labor shortage. The average baby boomer turned 65 this year, and a lot of people left the workforce a few years early for COVID and just never came back. So, I think we'll see continued strong employment, and that bodes well for being an investor into multifamily. And then obviously self storage has been traditionally recession resistant, and as long as you don't have somebody build a new facility right next to yours or across the street, or some Kmart doesn't turn into a storage facility, that's largely recession resistant, and I think another safe asset class to diversify into.
Well, Jack, this has been a great conversation. I really appreciate your insights, and I agree. As the market turns, and then we're actually starting to get real indications that the interest rates are kind of where they're going to be, then it is a good time to get in. Now we got to. There'll still be some valuation drops, but at the same time, like we're not going to see. The Fed is not indicating that they're taking this thing through the roof, which we haven't. We weren't sure of 2 months ago, last month. But now I think we're getting some clarity, and I think the market can get more comfortable, and I think the spreads will continue to shrink and get back into normal range. But I like to end every episode with a bit of gratitude, right? Because all of us probably had somebody that believed in us or gave us a leg up along the way that we maybe didn't deserve. And I want to give you a little bit of a forum or an opportunity to give somebody a shout out and say thank you publicly.
Sure. So a couple people actually, I'll do a couple real quick. So Don McClellan was my college landlord, and I actually went to Vegas. It was shortly after my 21st birthday, and bought a book at the airport, How to Make $1 Million in Real Estate. It's one of those paperbacks at Hudson News. I came back, called him for some advice, and 30 days later, I had a house, no money down, almost no money down, 2002. So just being able to be a mentor and get me into the business quickly, that was great. And then Mark Chanley and Scott Mabey were my first investors, and they were a client of mine from the IT industry. And I was just having a conversation. We were friendly. We'd grab a drink here and there, and I told them I wanted to do real estate full time and get out of the IT industry, and they had the faith to come in and work with me right off the bat. We took a few lumps because of the 2008 crisis as I was as we were all figuring things out. So eternally grateful for those guys, and really gave me the kickstart, of a 20-year plus career in real estate now.
Yeah. I mean, I know, especially the first people that say yes, like I will trust my money with you, is really a life-changing event, right? Because unless you're, a complete narcissist, like that is such a big, it's a big yoke to carry, right? It's a big obligation because somebody's spent years probably earning and saving that money, and then they turn around and say, yes, I trust you to get it back to me plus some. So yeah, I totally appreciate that, and I hope those guys get a chance to listen to this episode. And then your other one, sometimes you just have to get into the game, right? And even though that like the long-term game wasn't short for single family, no money down strategy, you got in the game and it changed your life. And I mean, that's the same way I feel. Like we got in 2007, and started investing in 2008, just whatever we could do, whatever we could get our hands on. And, I look back and there were some stressful times because I felt like I was on the clock, around the clock, but I would never look back and say, man, I wish I hadn't done that, because getting in the game has made everything, it's changed everything for me. So I love that story. Well, Jack, I guess, how can the listeners get in touch with you?
Sure. So our company is JKAM Investments. It's JKAM for JK Asset Management, jkaminvestments.com. We're also on all major social media. We have a YouTube page, Facebook, Instagram, even TikTok now, apparently. I don't do any dance moves, but the social media team has that. And, our flagship product is our diversified fund. So if you only have 100 or 200 grand and you kind of are afraid of concentration risk into one individual deal, our current fund has 8 different allocations across multifamily and self-storage. So that was one of the problems I saw in the market was if you're new, or even if you just don't have enough money to have 50 deals yourself, I wanted to provide a product that allowed diversification across multiple syndication deals. And that's our primary product. We also have the opportunity to go individual deal by deal as well. And love to network with investors. I'm not a CPA, but love to just strategize on tax strategy, mindset, and just how to help everybody, lead their best lives and be successful in investing.
Awesome. Well, Jack, I love the way this conversation took a kind of a mindset and then we brought it back to real estate, but I think there's so much there to unpack. And I hope you guys out there, you enjoyed that conversation, but thank you for being on the show.
Thanks for having me. Let's do it again. And I'd love to have you on my show sometime as well.
Awesome. I'd love to be there. I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.